Stocks mostly higher, dollar hit by weak ADP data. U.S. stocks rose on Tuesday, building on the previous session's strong gains as investors awaited a resolution to a stalemate between congressional Democrats and Republicans on a fresh fiscal relief package. The Dow Jones Industrial Average picked up 0.6%, lifted up by gains in McDonald's Corp. And United Health Group, Inc. The S&P 500 index rose 0.4%, and the Nasdaq Composite Index finished 0.4% higher. Asian markets were mixed on Wednesday after a report that the U.S. and China will meet to discuss compliance with their Phase 1 trade deal. High-level talks between U.S. and Chinese officials will be held on August 15th. During the event, China will likely bring up concerns over the U.S. crackdown against Chinese tech companies. On the data front, a private survey of China's services sector in July showed a slower expansion compared to the previous month. In particular, the Caixin Market Services Purchasing Managers Index came in at 54.1, lower than June's reading of 58.4. Japan's Nikkei 225 slipped 0.6%, while Hong Kong's Hang Seng Index edged up 0.7%. Shanghai Composite rose 0.2%, South Korea's Kospi rose 1%, while Australia's S&P ASX 200 fell 0.5%. European stocks rose on Wednesday amid a series of upbeat quarterly results, but weaker than expected Eurozone economic data capped gains. The Pan-European Stock 600 closed up by just 0.5% as July's final Eurozone PMI reading came in at a modest 56.5, a weaker rebound than expected. As for earnings, Commerzbank posted a better-than-expected 21% dip in net profit to 220 million euros for the second quarter. German insurer Allianz reported a 29% decline in net profit for the quarter to 1.53 billion euros, while BMW swung to a 666 million euro net loss before interest and taxes in the second quarter. Overnight, the U.S. market registered its fourth straight day of gains amid optimism on a new virus relief deal. The Dow Jones Industrial Average gained more than 370 points as Disney shares rallied by nearly 9%, even though it reported a $3.5 billion loss. The S&P 500 rose 0.6%, while the Nasdaq Composite ended the session 0.5% higher. The tech-heavy benchmark briefly crossed the 11,000 threshold. On the data front, the final monthly reading of the ISM Service Sector Purchasing Managers Index jumped to a reading of 58.1 in July, beating expectations and signaling stronger economic growth. Meanwhile, ADP said that only 167,000 private sector jobs were created in July versus the 1.88 million expected. June number was revised up to 4.3 million from 2.4 million. Separately, the trade deficit narrowed 7.5% in July to $50.7 billion. Against this backdrop, the dollar came under a more severe selling pressure and remained on the defensive early on Tuesday. The euro-US dollar climbed back to two-year highs around 1.19 and clings to the upper end of the range despite overbought conditions. The pound sterling US dollar registered fresh March highs around 1.3180, with the 1.32 barrier coming in the market focus now. The US dollar Japanese yen retains its bearish bias, targeting the 105.00 handle. Elsewhere, oil prices rallied to fresh early March highs on Wednesday as traders cheered the U.S. crude inventories fell sharply and the dollar weakened. According to the Energy Information Administration, U.S. crude inventories fell by 7.4 million barrels last week versus the 3 million barrels expected. Brent crude rose to $46.20 area but retreated to the $45.20 area by the end of the day. Earlier on Tuesday, the prices retained a bullish bias, but the impetus looks limited. Meanwhile, gold prices extended the rally to $2,055 per ounce, posting fresh record highs on Wednesday, supported by weaker U.S. dollar after a softer-than-expected ADP private payroll report ahead of Friday's U.S. government employment data. Now, as the precious metal has climbed above the $2,000 per ounce handle, investors are starting to bet on further gains to $3,000 per ounce in the medium term. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.